Hello, and you're welcome to this special edition of Global Business Insights, where we look at the Nigerian Central Bank Monetary Policy Committee decision that was taken today. The Monetary Policy Committee voted to raise policy rate by 50 basis points from 26.75% to 27.25%, to raise the cash reserve ratio to 50% for deposit money banks and 16% for merchant banks. And the committee also held the liquidity ratio at 30%. Here is a clip from the governor's address earlier today.
The committee was unanimous in its decision to further tighten policy and thus decided as follows. 1. Raise the MPR by 50 basis points to 27.25% from 26.75%. 2. Retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Raise the cash reserve ratio of deposit money banks by 500 basis points to 50% from 45%, and merchant banks by 200 basis points to 16% from 14%. 4. Retain the liquidity ratio at 30%. Considerations. The committee noted the moderation in headline inflation year on year in July and August 2024. In addition, the MPC noted the relative stability and convergence in the exchange rate across the various market segments, resulting from the bank's tight monetary policy stance. This is expected to improve confidence, which will enable economic agents to plan in the medium to long term. The committee was, however, unanimous in recognizing that a lot more is required to actualize the bank's price stability mandate. The MPC noted that even though headline inflation trended downwards due to a moderation in food inflation, core inflation has remained elevated, driven primarily by rising energy prices. The uptrend poses severe concerns to members as it clearly indicates the persistence of inflationary pressures. Members thus reiterated the need to work in close collaboration with the fiscal authority to address the current upward pressure on energy prices. The MPC noted the continued growth in money supply, recognizing the need to curtail excess liquidity in the system, as well as address foreign exchange demand pressures. Members were also concerned about the growing level of fiscal deficit, but acknowledged the commitment of the fiscal authority not to resort to monetary financing through ways and means. Furthermore, members observed a strong correlation between FAC releases and liquidity levels in the banking system, as well as its impact on the exchange rate. The committee, therefore, agreed to increase monitoring of future releases with a view to addressing its effect on price developments. On food inflation, the upside risks remained flooding, hike in energy prices, scarcity of PMS, and most importantly, security in farming communities. Considering the weight of food in the CPI basket, members recognize the efforts of the federal government in addressing insecurity in the farming communities and stress the need to remain steadfast. In addition, the MPC applauded the ongoing efforts of the federal government of Nigeria to bridge the supply deficit through duty-free import window for food commodities. The committee expressed optimism that the lifting of refined petroleum products from Dangote refinery will moderate transportation costs and significantly support the easing of food price pressures in the short to medium term. This is also expected to moderate foreign exchange demand for importation of refined petroleum products, with a positive spillover on external reserve and improvement in the overall balance of payment position. Members assessed the performance of key financial soundness indicators and noted with satisfaction that despite familiar headwinds, the banking industry remains safe, sound, and stable. The committee, however, emphasized the need to sustain supervisory oversight on the industry to strengthen its continued support to the economy. Following these considerations, members deliberated on the optimal policy option to sustain the downward in price development, contain emergent risks to inflation, stabilize the exchange rate, and safeguard the banking system, while also shielding the recovery of output growth. In addition, members noted that the real policy rate remains negative, even after the recent moderation in headline inflation. To attract investments into the economy, efforts must be sustained to achieve a positive real interest rate. This would enhance the economy's competitiveness for international capital, thereby improving the exchange rate. Following a review of the upside risks to price development and the downward risk to the recovery of output growth, the committee opted to tighten policy further to safeguard the gains already accrued in moderating inflationary pressures. Key developments in the domestic and global economies. According to the National Bureau of Statistics, headline inflation moderated to 32.15% in August 2024 from 33.4% in July, driven by a decline in food inflation, while the core component inched up. Food inflation eased to 37.52% in August 2024 compared with 39.53% in July, while core inflation rose marginally to 27.58% in August 2024, compared with 47% in July. Month-on-month headline inflation fell to 2.22% in August 2024 from 2.28% in the preceding month, while food inflation eased to 2.3% in August 2024 compared with 2.47% in July. Core inflation, however, rose marginally to 2.27% in August 2024 compared with 2.16% in July. 2.16% in July. Real GDP year on year grew by 3.19% in the second quarter of 2024 compared with 2.98% in the first quarter, driven by both the oil and non-oil sectors. Staff forecasts indicate that the economy will grow by 3.32% in 2024. The external reserves stood at $39.07 billion as at 19 September 2024, an increase of 17.4% compared with $33.28 billion in the corresponding period of 2023. This represents 8 months of import cover for goods and services and 13 months of import of goods only.
Indeed, it was a surprise to most analysts expecting a cautious loosening on a more than 2-year tightening cycle. Local business leaders have been warning that higher interest rates continue to stifle consumer spending and investment. The 12-member MPC, however, remained cautious not to declare victory over abating headline inflation, especially as core inflation still edged higher in August, implying that underlying price pressures remained strong, with new pressures such as those linked to floods. The MPC saw a healthy banking sector and moderately growing economy as signs of resilience. More concerned they were with the negative real interest rate. That's a major disincentive for investors, and the need to safeguard the gains already achieved in moderating inflation. The central bank also observed that it would monitor future releases by the Federation Accounts Allocation Committee (FAC), which it noted was a major factor with rising deficits and inflation. To see a boost in investment inflows, analysts also see the need for comprehensive fiscal and other reforms contributing to macroeconomic stability and a much easier environment to do business. My take is that the CBN is waiting to be more confident that inflation is sufficiently tamed before easing, and much will depend on the data, as the governor gave little clues on what could happen at the next November meeting. Meanwhile, the MPC pleads to the business community for more patience. Well, that's it on this special edition of Global Business Insights. Bye-bye.